Let us having a monthly capital market development in China and Asia. Today we will have a Indian paper on payment. India has been very successful in pushing out their UPI system. The technical details are being very interested in it, reading it, but still didn't get it fully understood it. And I hope that I can learn from today's seminar. So Meghana will start, and the floor is yours. 35 minutes.
Great, thank you. It says somebody else is sharing. Okay, I think I should be able to share now. Yeah. Can you see my slides?
Yes, I can. Good.
Okay. Great. Thank you for the invitation for this webinar. Bernie reached out to us. He said that he's at a board meeting, but we're really happy that you could include us, fit us into the program. Thank you, Zico, as well. This is joint work with Lance CHENG, who's actually moved from Liverpool back to the US, Pulak, GHOSH, and Nirupama, and I think they are either already in the webinar or they'll probably be joining in a short while. So any questions that I don't answer, they'll probably be chiming in the chat or in the discussion section afterwards. So again, good morning to those of you in Asia, a very late evening from me and Divya in the East Coast. So if we sound unusually energetic, you can blame it to the miracle of UPI, I think. All right, so let me spend a few minutes sort of motivating how this paper came about. So this has been part of a series of paper that Pulak and I have been writing, with Nirupama and a couple of other co-authors on capital market development in India and other developing economies. And one of the things that you see over the past decade has been the rise of the retail investor, right? You see an unprecedented number of individual investors entering the stock market, be it Robinhood investors in the US to investors in meme stock and crypto and so on. So the news media, the business media has been all over it, right? Any business press article that you look at, you have these headlines about the rise of the retail investor. And nowhere is this more dominant a phenomenon than in India, where you see that India is now the world's fourth largest stock market. It has over 151 million investors, $4.3 trillion, and so on, right? So the puzzle here, of course, is, what is leading to this rise, right? Is it demographics? Is it increase in incomes? Or is it something more fundamental in how money is moving to these markets, right? And India is actually, one of the best sort of case settings to actually understand, the role of payment systems, because India's stack, which is really India's digital public infrastructure, has been getting a lot of attention. People hail it as sort of the blueprint for global success. And it's this three-layered system of identity, payment systems, and then the data layer, right? And a lot of academic literature has actually examined the impact of this digital rails to credit access. Okay, so be it whether the impact of Aadhaar, that is digital ID, or PMJDY, or even UPI, Pulak and Nirupama have a paper on how it affects credit access and so on. Okay, and this is all sort of at the credit market layer. Now, what is missing, the unanswered question, if you will, is the role of payment systems. So if you think about it, your traditional payment systems typically have, they're known for sort of delays, they're, the limited operating hours, there are fees associated with transactions. Some even have limits on the minimum number of transactions that you can actually use and so on, right? So the question that we had is, if you move away from these traditional systems, payment systems, to an open, real-time, interoperable rails, so you remove these frictions, these market frictions, and allow for the movement of money, which is instant and free, you should see that the type of investors in the market are different and the reaction speed should be different. So really, who is participating in the market? How does that change? And how quickly can they respond? Okay? And by interoperability, I just want to make sure that it's not just digitization, it's really about any bank account funding any broker app, right? So your access to any sort of bank account through this interoperable system. Now, also note that this is not just an India-specific question, right? So here is sort of from Thunes, the showing you the rise in global real-time payment adoption. And you can see that this has just sort of exploded, in the past couple of years, whether it is Fed now in the US, which is actually a bit lagging behind some of the other real-time payment systems, or you're talking about PIX in Brazil and so on. You see that this is something that is, this payment system architecture is on the top of people who are working on these capital markets, and it's not just sort of an India specific question. So this is where we come in. What we want to do with this paper is ask just 4 very straightforward questions. Does open payment infrastructure increase retail market participation? And we're going to use India's UPI as the context for this. And in the process, at least try to disentangle whether it's just general digitization or it's really this architecture of being an open system versus a closed system that is driving the results. And who benefits from it? Who are these investors who are taking advantage of it? What is the heterogeneity by gender, age, and by location, if you will? And what are the channels? Is it speed? Is it that it's bringing in investors previously disadvantaged? What are sort of digital ecosystem effects? Or is it allowing for some sort of a financialization of savings? So what really are the mechanisms? And then finally, should we care, right? So these guys, these investors that come into the market, are they actually seeing better returns once they are participating in the market? So what I'm hoping to convince you is what we find are answers that are both encouraging but also cautionary in nature. Our first headline result is that UPI expands participation. So for every standard deviation increase in UPI exposure, and give me a couple of minutes and I'll get to how that is defined, we see an increase in the number of transactions in a particular area that's exposed to UPI and an increase in the number of investors participating in the market. Okay. We also see that it's the architecture, it's not really digitization. So we run these horse race between UPI, which is an open system, versus YONO, which is a closed system, and we find that the UPI effects are much larger. There's clearly some democratization because you see that young investors or below the age of 30, women, small investors, and those using fintech platforms see the largest gains. When we look at mechanisms, we find support for 4 different mechanisms. We find that it's about the lower costs. We do a flash crash analysis to actually tease out these effects nicely. We see that it's more small value trade, more small investors, so really a clear democratization of investment. We also see digital spillover, so it's stronger effects in urban areas, so where there's a bigger digital ecosystem and there's financial literacy, that's where you see the greatest gains. And we do see some savings formalization, okay? But there's also a dark side to this. So overall, what we find is that though these investors are coming into the market, participation does not necessarily equal better returns. You actually see over a long term, like 140 days, you actually see some negative returns, especially for small investors. So that in a nutshell is sort of where what I'm hoping to show at the end of this this seminar. But just a quick nod to the literature, there's a lot of literature in this, emerging literature in this space. There's a strand that's looking at these next-gen payment systems and their role in financial inclusion. My discussant today, Divya is part of some IMF work, important IMF work that looks at this across the world. We believe that we are sort of one of the first papers to look at how this payment innovation affects retail market participation. Relatedly, there are these papers on open banking and what the implications are for market structure and consumer welfare. And where we sort of contribute to that space is to show that this system design of this architecture actually has implications for capital market access. And of course, more broadly, there's this older literature right from Barber and Odin to the more recent fintech literature on the role of technological innovation and how it affects retail investor behavior. And our sort of findings fit in very nicely to that. So in the interest of time, I'm not going to spend too much time on it. So let me sort of get into what kind of data we use. really three key data sets. So one is deposit data from the confidential data from the Reserve Bank of India, which helps us construct this UPI exposure measure. Then we use the universe of retail trading data from the National Stock Exchange. So this is really rich data. So we use it from 2015 to 2020 Q1. So it covers the period when UPI was actually introduced. And we have details on every trade transaction. We have details on investor demographics, so age, gender, PIN code. And we're also, for a subsection, we're able to map which brokerages these investors are actually using to trade. Okay. And then we have geo coordinates for telecom towers. And I will show you in a minute that we use this to sort of identify, where internet connectivity has enabled sort of UPI usage. So before I go into the trading data, let me just spend a couple of minutes talking about, UPI and how we actually construct the measure, right? So a lot of people in this room have worked on payment systems. So UPI is India's unified payments interface. It's a payment system and an interoperable protocol, which basically allows third-party vendors to build apps providing payment services to all customers of participating banks. So what does that mean? It basically means that a customer is connected to multiple banks through one single unified API, okay? And it enables interoperable, instant, zero-cost transfers, and there is no sort of minimum limits like how you would have maybe in RTGS. There are no limited hours that you might have, say, maybe in NEFT, and there are no delays really. So this is really the big advantage, technical details at least, that you will see of UPI versus others. So there's a section in the paper that actually compares UPI to these other payment systems, and actually payment systems, outside the US like Pix and FedNow and so on. So, if you're interested in those details, I'd really urge you to do that, to sort of take a look at that. Now, so clearly, there's been a lot of uptake of this, right? What you see today is that India leads globally in real-time payment transactions, largely because of this UPI introduction. So as of 2023, they processed 129 billion, which is more than the total of the next 9 real-time payment markets. So this is, a big, sort of a very interesting and important question that we're looking at. So we define UPI exposure as the total deposits of early adopter banks by the total deposits of all banks. So what we're trying to do here is exploit 2 sources of variation. Variation in bank level adoption timing, meaning that there are some banks which adopted UPI early. As of November 2016, you can get that list off the Government of India website. And there is regional variation where you have this UPI adoption. So what we're relying on here is this work by Higgins and Nico Krause and his co-authors, which basically say that there are significant externalities where, you have early UPI adopter banks and dominant players. You see that, there's increase in digital transactions in those areas much higher than in other places. Okay, so this is what goes into constructing this PIN code level measure, which is, for now, not time varying. If you look at the trading data, our main outcomes are number of transactions in a PIN code year month and number of investors, that's the number of active investors in the PIN code year month. So the unit of observation is really a PIN code and a month, okay? We have a bunch of other investor level measures on risk and trading speed and portfolio diversification, and I'll get to that in a little while. Bird's eye view, if you just look at the summary statistic, there clearly seems to be something, right? So the left panel is showing you the difference in number of transactions between high and low UPI exposure PIN codes. And you see that over our sample period, that difference is actually growing. The right figure shows you the difference in number of investors. Again, difference between high and low UPI exposure. And if you can define high and low as median or even like top tertile or so on, similar patterns exist. So clearly there is some link between UPI exposure and stock market activity. So now let's go into detail on the questions that we're asking, right? First question, so does open payment infrastructure increase retail trading? How do we do this? We run a classic difference in difference. So these are our Y variables. We are interested in this beta coefficient, which is the differential change in stock market participation in each PIN code following, UPI adoption. We have a bunch of district time fixed effects and PIN code fixed effects. And I'll show you sort of a different ways that we try and address identification in a couple of minutes. But the classic DID, basically, before doing that, we see the balance test looks pretty promising. So we don't see any big differences in growth or levels of our dependent variables in these high and low UPI exposure pin codes. Okay. So also sort of in investor demographics, they're really not that significantly different. So you do the DID, and basically what you find is that one standard deviation increase in UPI exposure leads to a 6.1% increase in monthly transactions. These are your economic effects. An 8.6% increase in active investors relative to the pre-treatment means of these investors and transactions. Pre-trends, no evidence of pre-trends. So you do a dynamic estimation of this to look at parallel trends assumptions, and it doesn't seem to be like there are any pre-trends. So that's the red line that you want to look at. I also highlight this blue line because the enhancement of interoperability actually was increased in September 2017 through a multi-bank model, and that's where this this blue line, and you see that it's increasing even further from then. But this is really our our treatment, our shot that we're looking at. Okay. Now we also see that it's not just about digitization. The architecture really matters. So the test that we're running here is a horse race between UPI exposure and YONO. YONO being a closed loop payment system by the State Bank of India. Okay. So for this test, we are restricting it to all investors who are SBI customers. And so for SBI customers, we look at participation through UPI exposure areas versus YONO exposure areas. And if you look at the significance levels and just look at the economic effects, you see that the effect of UPI is much larger than the YONO effect. So it's really not just about general digitization, which you have seen with just YONO, but what is happening here is that it's the actual open system architecture that's really kicking in, and that's doing the heavy lifting when you talk about financial market access. Yeah. Okay. So clearly, when you think about this, there are some threats to identification, right? So the first thing is, given the nature of our tests, we have district time and pin code fixed effects. So maybe there are pin code time confounding effects, right? So for this, we do this classic Khwaja and Mia sort of analysis, wherein we look at the same investor and we compare trading in brokerage accounts that are limited to early adopter banks versus others. So the idea here is that any confounders at the pin code level will be addressed when you look at this within investor tests. Okay. So essentially, this is sort of the early adopter is one if the brokerage account is associated with an early adopter bank. And this beta will basically capture the difference in transactions for a UPI-enabled brokerage versus others. And the results here are very heartening, right? So whether you look at investors with 2 or more brokers during the entire period or 2 or more brokers in each month, what you basically see is the same investor executes more transactions through brokerage accounts that are connected to early adopter banks than in brokerage accounts that are not connected to early adopter banks. So clearly, our results are sort of robust to any sort of pin code time confounding effects, if you will. Okay. Now, the second thing that you might be worried about is maybe it's not UPI, but it's these characteristics of these early adopter banks that you might be worried about. So the idea here is that the early adopter banks, maybe they're super innovative, they have better infrastructure, and that's what's driving trading rather than, this payment system infrastructure that we're talking about. So while the fixed effects to a large extent actually address that, what we do is we look at bank holidays. So in India, different states have different regional bank holidays. And what we're trying to see is if it is all about bank quality, then you should see that customers of early adopting banks will continue enjoying an edge during bank holidays, which is when only digital channels are available. You can't really go into the bank and then, actually place a trade and so on, right? But the results that we find actually suggest something opposite. So first, just note that post times UPI exposure is still very positive. So it is going up. Post adoption of UPI, transactions and number of investors. But what is interesting is this triple interaction. So what we're seeing here is that the gap between high and low UPI exposure pin codes is actually narrowing. So what it's telling you is that UPI reduces the relative advantage of being tied to an early adopting bank confirming that it's the infrastructure. It's not really about bank selection that is, driving our results. Okay. The third thing that we do is, to look at these placements of these telecom towers. So what we're doing here is using the company Reliance Jio 4G rollout as a natural experiment. It's important to note that this rollout of this 4G network depended on technical and regulatory factors. So it was all about like tower placement and spectrum availability. So it's really more sort of exogenous variation in early internet access. And that was a critical sort of enabler of UPI usage, okay? So the idea here is to say that if UPI is the real driver, then we should see areas with early geo coverage should see much stronger effects of UPI exposure. And that's exactly what you find in this blue, highlighted area, that UPI's impact on market participation is much larger in areas that gained early access to 4G networks. Now, as a sort of placebo, we also look at non-4G. There are some effects there, but they're much, much smaller than what you would see with just, the 4G networks. Okay, so I'm going to skip over these heterogeneity results in the interest of time. I'll come back to it if we have time, but I want to talk a little bit about the mechanisms, right? So we showed you that UPI, leads to greater participation in the stock market, but why, right? What are the mechanisms? First, we argue is because of reduction in transaction costs. They're able to instantly transfer money. So where is that feature most essential? Well, let's look at two flash crashes. So we look at two crashes in September 2019 and in March 2020 where the market fell. And we're trying to see if in UPI exposed areas, you see more transactions in a window around these flash crashes. So we look at a 12-hour window before and after each crash. And for this, we actually use high-frequency, time-stamped, tick-by-tick transaction data from the Bombay Stock Exchange over this period, okay? And here, this is showing you both the crashes combined, and then both of them separated out, 2019 and 2020. Again, the same sort of DID setup, but, over a 12-hour window before and after. And what you see is that investors in high UPI exposure regions engage in more transactions around the flash crash than in those. And you can see that the N reflects, the stick-by-tick, very high frequency transaction data that we actually use here, right? The second mechanism that we want to look at is democratization of investment. So is it actually lowering entry barriers to previously marginalized investors? So we look at two things here. One is, do you see more small value trading go up? So when you look at the number of transactions, so we look at small investors who are defined as bottom 30% of transactions in terms of trading value. That comes out to be about 30,000 Indian rupees. We also do another cut for like 50,000 Indian rupees. And you basically see that a greater number of transactions by small investors. We also see a greater number of small investors participating in the market in these high UPI exposed regions. So clearly there is a lowering of entry barriers. The third mechanism we test is digital ecosystem. So what we were trying to get at here is, are there some sort of network effects, meaning that the effect of UPI should be larger in areas where there's more financial literacy, more use of these fintech apps, and more sort of these network effects. And the closest we've sort of been able to approximate it for now is to look at the split between urban and rural areas. And we see much stronger effects, as you can see in the t-test in the urban areas compared to the rural areas, suggesting that, UPI's impact operates through much broader financial literacy and network effects. So it's sort of like a self-reinforcing mechanism. And then finally, we were looking at financialization of savings, which is the idea that if you look at areas that are ex-ante high cash usage, okay, so like say top terciles of ATM withdrawals, do you actually see bigger shifts in market participation? And clearly, when you look at this in triple interaction, you do see that high UPI PIN codes in high ex-ante cash usage areas actually see biggest shifts in market participation. So sort of suggesting that households are actually moving from cash into these formal financial markets, and UPI is enabling this financialization, if you will, of savings. Yeah. So these are the four mechanisms that I showed you. So the big question, right? Should we care? We've shown you that there are all these big benefits of UPI, that it's enabling stock market participation, but what about in terms of returns? So we look at buy and hold returns. We actually look at excess returns. Then we look at portfolio diversification. We look at, are they trading in risky assets defined as above median stock market volatility? And then trading speed. So what is the number of the difference in dates of trade by a particular investor? What we find is that short term, the full average investor is not making any money, but over the long term, he's actually losing money. There's a negative return, excess return over the 140-day trading horizon. And in particular for the small investors, as you can see in the very last column. If you look at trading behaviors, the small guys seem to be taking on more risk. They're diversifying less. And they're also trading much more frequently, right? Suggesting that there may be some suboptimal investment that's going on here. Additional tests, we do a bunch of different things. As I said, we do some heterogeneity tests where we look at, we find that the greatest impact is for young investors, women, investors that are trading through fintech brokerages. We also see when you look at physical trading locations versus digital, you find that there's more trading that's happening in digital channels. We do some placebo tests. We randomize UPI exposure. You don't find any results. We use institutional investors. Again, we don't find any results. We use an alternate time varying sort of classic Bartik instrument. All the results go through. We rule out demonetization as a confounder, which happens during this thing. We talk about it in the paper, but I don't think the version that Divya has these tests where we show that the distance to currency chess, which is sort of a measure of cash availability during demon, is not correlated with our UPI exposure measure. And then we've done a bunch of things on addressing the skewness in the dependent variable, but this is stuff that needs to work itself into the draft. So overall, these are our conclusions. So interoperable systems.
Oh, Meghana, given you still have time, so let me ask you one question which puzzles me. Just two slides earlier. No. Yes. No, the randomization one.
Oh, okay.
Can you spend some time to talk about it? What does it mean by randomized UPI exposure? And you said it's no effect. I would think that if you really the core is a UPI, then you should have some effect. So
basically what we're doing here is we are randomizing the date of adoption of UPI across banks and across time, right? So we know that there are some early adopter banks, who adopted banks banks that adopted UPI as of November 2016. If you randomize that and you randomize both the timing and the job. So it's a classic placebo test. You shouldn't expect to see any results, right? Because it's really driven by these network effects of UPI with these early adopter banks. So that's what I was referring to.
Yeah. Okay. Just
the other thing we do is this, is this institutional investor sample, right? Because these institutional investors are not that reliant on UPI as your retail investors are. So when we look at the institutional investor sample, I mean, they're much smaller that we have in this data than the retail investors. You see that the number of transactions and number of investors there is no significant uptick that you see after, UPI in high UPI exposure pin codes. Mm-hmm. Again, sort of saying that it's really UPI is a way for these retail investors to actually come into the market because, it's enabling them to easily move funds from different bank accounts.
Got it.
And actually, my timer says 25 minutes, but I'm happy to take a couple minutes more if you can give me. So I think these are interesting results. So if you look at heterogeneity by age, we look at young, middle-aged, and mature investors, and you look at female and male, and then you look at fintech and non-fintech. There are effects all around, right? As you would expect, like everybody benefits. But then if you compare it to the sample mean, you see that the highest effects are really for young investors, for female investors, and then the fintech customers, right? That's where you see the biggest increase in stock market participation following UPI.
Can you also explain this crash thing? You mentioned crash. You use a crash to talk about the cost.
Was really to look at this reduction in transaction costs, right? So the idea here is that because of UPI, there is lower transaction costs, there's ease of entry. So these things really matter during flash crashes, correct? So when there is a flash crash, you should see that if you had access to UPI or you're in a high UPI exposed area, you should be able to get in and out of the market much quicker than if you were not using UPI. That's sort of the general idea. So what we do is this tick by tick data from the Bombay Stock Exchange. We're looking at these two specific crashes. I mean, there are a bunch of other crashes that we could potentially look at. We picked these two because it didn't seem like there was any confounding effects around it, like there's no COVID at that point, at least for September 2019 and so on. And when you do that, you see that UPI exposed PIN codes see much higher activity around the flash crash than in non-UPI exposed PIN codes. So really suggesting that if you say that it's transaction cost, this ability to transfer money instantly is really what is driving this, it should be most obvious during the crash period. And that's exactly what we find.
Is this crash times post times UPI exposure, or what is this?
It's post-crash. So this is a
What do you mean by
12-hour
post-crash?
window before and after each crash.
Oh, I see. I said 12-hour. I see.
12 hours, yeah.
I see. I see.
So this is like
Okay.
16 million
Good.
observations that you're looking at. Yeah. So headline result, interoperable systems lead to more stock market participation. It's the openness. It's not just about going digital, because as I showed you, the effects of UPI sort of dominate the effects of a closed loop system like YONO, which means in YONO, it's only SBI clients that are able to use, but with UPI, any bank account can actually be accessed. And that seems to be the real driving force. Access is more democratic, and we see these 4 channels, some support for these 4 channels. But participation is not necessarily equal to performance. So, we see lower diversification and negative long-run excess returns for, small investors. So the key takeaway that I'd like to leave you with is that payment design matters. So it's really about open, interoperable systems which can broaden access to capital markets. But it also seems to suggest that to make access welfare enhancing, we probably need, complementary policy and design, whether it's, educating these investors or, having more protective guardrails, what you will. So some work for, I guess, the policymakers. I'm looking forward to Divya's comments. Unlike me, who's just talking about payment systems, he actually has papers on payment systems across the globe. So
thank you, Divya from IMF.
Great. So thanks so much for having me discuss this paper. It was really interesting to read. And as Meghana says, the fact that I can be awake and excited about it at this 1 hour in DC tells you something. So just to confirm, hope you can see the slides, and it sounds like you can hear me. Yeah, so this is a paper by Meghana AYYAGARI and her co-authors, at least a couple of whom I saw in the Zoom meeting. And since I'm at the IMF, I'll highlight the usual institutional disclaimer. These are my own views and shouldn't be associated with other people at the IMF. So let me start a bit broad in terms of setting the context for this paper. Also keeping in mind the kind of broader Asian audience here. Just that I think that the kind of big picture context for this paper, as I see it, is that over the last couple of decades, there's been a kind of payments revolution in emerging markets. So kind of, and importantly, with very different approaches to that revolution in different parts of the world. So kind of in the places where credit cards never got big, a couple of decades ago, mobile money became big in Africa. There were kind of fintech, largely until recently closed loop systems with a lot of private initiative that were very big and very important in China. And there have been these kind of more open payment systems where, the launch has also involved various forms of more public support. And there are several examples of these, and I think the kind of most prominent of these and the biggest, in part because the countries are the biggest, are India and Brazil. And so the paper is about looks at digital payments in India, where what is big is UPI, the Unified Payments Interface, and this figure on the left, drawing from our work, kind of shows the scale and speed of this transition. So kind of in under a decade, digital payments really took off. And in our work, we kind of highlight the role of interoperability. So kind of seamlessly being able to make transactions across different apps. And indeed, tellingly, actually, most transactions on UPI take place across two different apps, right? So there are transactions that in the exact configuration that they took place in could not happen without the interoperability. And we estimate that this interoperability had a kind of large positive impact on the demand for digital payments. And so I think the kind of this payments revolution, I think, raises the question of when digital payments grow a lot, what are the broader implications of that kind of development? And I think that's kind of the broad context for this paper. So to start with a kind of my read and kind of what I see as the main elements of what this paper does, I see this as being a paper about payments and financial inclusion. And the broad question that this paper is after is, I think, how do digital payments shape retail stock market participation? And upon reflection, there's a kind of very basic intuition that links digital payment systems and retail stock market participation, right? Which is that if you are a retail individual investor and you want to buy stocks, you have to move your money onto investment platforms. So you have to use payment rails to move your money onto the investment platforms. And that means that better payment rails could help because they could reduce frictions in the process that must happen for retail stock market participation. Now, to work on this and think about this, the authors are going to draw on some fantastic data that will help them get at stock market participation. So they have very detailed data on trading from the National Stock Exchange, where, very importantly, they'll be able to figure out which trades are made by the same investor. So they can kind of group trades at the investor level, which as we'll see, is kind of critical for doing the kind of very granular stuff that the authors are going to do. Now, to talk you through what the kind of main specification in this paper, the main kinds of specifications in this paper will do, let's start with the left-hand side, or the kind of dependent variable here, which is that the authors are going to look at the extent of trading, so the number of trades, or a kind of more extensive margin measure, which is the number of active investors, which is, and this piece is kind of really critical to be getting at financial inclusion and stock market participation, right? And this measure, the number of active investors, is where the authors are going to kind of draw the most on the granularity of the data. Kind of building on some nice work that some of the authors have done, also thinking about stock market participation. And so the question that the authors are going to ask is there more trading? Are there more active investors in the places, specifically PIN codes, which is a kind of very granular geographical subdivision, that had more exposure to UPI after UPI was launched? And so kind of the detailed data on trading is from 2015 to 2020, and UPI was launched in 2016. So that's the dependent variable. That's what's on the left-hand side. Then on the right-hand side, the way the authors are going to measure the UPI exposure, you're kind of drawing on the literature, including some nice work by some of the authors here, is they're going to use some very nice data that allows them to look at PIN code level deposits. And so what they're going to use is variation across banks in when they signed up to join UPI. And the measure for exposure to UPI is a kind of PIN code level deposit share. So places where there were lots of deposits at banks that joined early are going to be banks that had high UPI exposure. And it's a nice granular specification. The authors will be doing everything will be kind of at the PIN code month level with PIN code and district by month fixed effects. So that gives you a sense of the question and the approach that the authors use to answer this question. What do they find with that? So the kind of, again, my read of the main results. So after UPI was launched, in the places that had more exposure to UPI, there's kind of evidence of more retail stock market participation. So there's more trading volume and there are more active investors. So kind of in pin codes where the exposure to UPI was 1 standard deviation larger, transactions go up by 6% of the mean, and the number of investors goes up by about 9% of the mean. Now then, kind of the bulk of the work in the paper is kind of trying to establish why this is the case. And I kind of, in my mind, group the results into 2 main types of findings. So one set of findings is that the results appear specific to UPI as opposed to other types of digital payments and other kinds of digitalization. And here are the kind of the 2 main sets of evidence from my perspective. There'll be some very nice within investor evidence, and I'll kind of say more about this. And there is a horse race relative to other digital options. And the kind of conclusion from this set of results is, again, this impact on retail stock market participation seems specific to UPI, not digitalization in general. The second set of results is a kind of, wide and rich set of heterogeneity exercises. And there's a lot in the paper, kind of comparing what kind of channel the trading happens to, whether it's digital or kind of someone really going somewhere in person to do the trading. There's a granular set of geographical variation, variation in how much digital infrastructure there is, or how cash reliant that area was, and some variation that we heard about in kind of investor sizes and trading at high frequencies around crashes. And this heterogeneity evidence is then intended to speak to mechanisms, and I'll also come back to that. So I have kind of 3 main comments for the authors. I'll kind of attempt to be constructive throughout this, which I kind of, I'll talk about how I see the kind of main contributions to the literature from the paper, and then talk about interpreting the main results and mechanisms. So for me, I see this paper as speaking to 2 main literatures and having 2 main contributions. So the first of these literatures is about digital payments adoption and what sorts of downstream impact or benefits that brings. And I think there are kind of 2 very complementary streams to this literature. One part is thinking about kind of what does it take and why do digital payments grow, right? So what are the drivers of digital payments adoption? And that includes, things like demographics, maybe it's helpful to have young people that use technology. There are network effects, maybe payment system design matters. And I kind of talked about our work on interoperability. That's kind of one stream of this literature. And then there's a second stream of this literature, which is, once you have digital payment adoption, is that useful for some broader reason beyond just payments growing, which might be important in its own right, but are there other important downstream benefits? And here, as we heard from Meghana, there's a large literature thinking about the impact of digital payments adoption for lending, but also other dimensions, things like consumption, growth, bank deposits. And this is where I see this paper coming in, that this paper is asking about a kind of new dimension of downstream benefits that, at least to my knowledge, the literature has not thought about before, which is, what are the, how can digital payments help with growing retail stock market participation? So that's kind of how I see the first main contribution from the paper. And then the second literature and the second contribution, to my mind, is, how should we think about retail stock market participation and what does it take to have more of that? And, as the paper highlights, kind of the literature that this paper is most closely related to is kind of retail stock market participation in emerging markets, whereas the literature has largely focused on advanced economies. And actually, some of the authors have some nice work that shows that physical financial infrastructure and the presence of banks is very helpful in supporting stock market participation. And kind of I see the second contribution of this paper as highlighting that digital financial infrastructure can also play an important role, which again, I at least so I don't think that I haven't seen anything on that. So I haven't those for me, those are the kind of two main contributions. And I think that's a little bit different than the way the paper is framed, and that's kind of suggestion one. Then turning to the second comment and suggestion, the goal of the paper, as written in the introduction, and I think is consistent with what Meghana said, is to sharply separate the role of interoperability from digitalization or digital payments in general. Now, I think the paper has some very nice results that point to the specific role of UPI as opposed to other forms of digitalization and digital payments. And so for me, the kind of two main results that are really helpful for this, and drawing on the really nice data that the authors have, is that, so one, they'll look at investors that have multiple brokerage accounts, and investors like that use where they have accounts with banks that joined UPI earlier, they use those accounts more. And then, importantly, they can include investor by month fixed effects. So I think that's really nice. And then the second one, which we also heard about, is this horse race relative to a kind of closed loop platform offered by a very large public bank. So I do think that the paper shows that the results are specific to UPI. The question that I think the authors can engage more with is how we should think about whether this points to interoperability or just kind of digitalization or digital payments and payment platforms that are higher quality. So when it comes to this comparison between public banks and other options, I think there is evidence in the literature that, including prominent work that has been published already, that public banks kind of don't use technology in the same way with the same level of quality. Again, so I do think that this shows something very specific to UPI. But I'm a bit less sure that the results now speak specifically to interoperability versus quality. I think that this distinction could, between public and private banks could also be relevant for the within investor evidence, although I'm not super sure about that, and perhaps the authors can think about that. And the kind of broader question for me here is, when in both of these comparisons, the within investor evidence or comparing with the closed platform, the question for me is, would users kind of make the same choices if they had an option that was the same quality as UPI or kind of the best apps on UPI, right? Many of which are offered by private fintech firms, but without interoperability. And, so in the spirit of being constructive, I kind of see two options here, but, maybe there are other things there. So one is to kind of present more direct evidence that really gets cleanly at this distinction between interoperability and quality, and that might be hard. And the other is to kind of consider a somewhat more broad framing for what the paper is after, which actually I think is closer to the way the conclusion of the paper is written, which is that effective payment system design can improve the payment rails that are important and needed for stock market participation, and therefore help retail stock market participation. So that's kind of comment suggestion 2. And then my third comment is about this very nice and rich evidence on kind of heterogeneity and what we draw from that in terms of mechanisms, in terms of kind of why it is that digital payment rails and better digital payment rails can support retail stock market participation. And so I was kind of, this is a somewhat different grouping than the authors offer, but kind of I think there's lots of nice evidence in the paper and lots of interesting cuts. So one mechanism that I found kind of very intuitive and natural is that when there's high quality digitization, that enables a shift to digital pipelines. So when users are moving to retail, when they're thinking about stock market participation, they're going to use more digital pipelines. And the authors have this very nice result that the growth in retail stock market participation is through trading that happens on the internet and not with people physically going somewhere. Right. And then there's also this nice evidence that better digital connectivity and better digital infrastructure is more useful when there's more exposure to UPI, and that kind of this is more important in the places that were more reliant on cash before UPI. That's mechanism one. And mechanism two is that by doing so, by moving users to digital pipelines, this reduces frictions when it comes to retail stock market participation. And again, I think there's some very nice evidence in the paper on this, that kind of there's more growth for smaller investors, and as we discussed, kind of at higher frequencies when there are big moves in the market, it seems to allow investors to be more responsive more quickly. And so of course these are my thoughts, but I think they could kind of help a little bit in streamlining the kind of the presentation. And a few other comments, and just to run, I won't do them all in the same detail, just to run through them. There's a lot in the paper. I think a little bit of room to streamline the paper, and so a few concrete suggestions that I had. I didn't quite follow the hypothesis for the bank holiday results. That's one example. When it comes to the kind of return and risk results, I was thinking about Andre Schleifer and co-authors' work on how the counterfactual really should be kind of what these people would have gotten if they were investing in cash rather than excess returns relative to the market. So some suggestions there on streamlining. Another kind of I think important detail is that the shift in September 2017 only affected which banks the app providers were using to connect to UPI. And my understanding is that this did not affect users' ability to use many different apps across many different banks to make payments across apps. Then, given nice work by some of the authors that shows the importance of the kind of physical financial infrastructure like bank branches, I think it would be good to show balance on that. And maybe the last one I'll mention is that the very detailed data that the authors have ends in 2020, and UPI obviously then kind of continued to explode after that. So I was wondering if that continued growth shows up in more retail stock participation over a longer period. There's some more kind of small things here that I won't go through in detail. Okay, so kind of in summary, I think that this paper is showing that better digital payment rails can support retail stock market participation. And to kind of summarize my suggestions, I would kind of highlight more at least what I see as the two main contributions of the paper, that there are these new downstream benefits of digital payments adoption, that it can help with retail stock market participation, and that relative to the literature on retail stock market participation, that there's a significant role for digital financial infrastructure. I would kind of suggest either more direct tests getting at interoperability or a somewhat more broader framing, which I think still leaves lots of room for contribution. And perhaps some suggestions for streamlining the discussion of mechanisms. So again, I enjoyed the opportunity to read this paper. I think it's very interesting and on an important topic, and I look forward to the next version. Thanks again for having me.
Thanks, Divya. So we will move on to the Q&A. I have some basic question, and I will collect. If you have a question, raise your hand or type it. So one is that you probably in the future you provide more details of the background. For instance, what is the before this UPI? What are these traders can move money? What is the situation? You should please show us the app. How do you do it? And after this, how do you do it? How fast it is? That kind of thing, right? That is the key thing that I wasn't even, I know a little bit about it what's happening in China. How do we do it? in other countries, let's say US also, but I have no idea that what exactly you are doing. Okay. That's the one high level question, high level suggestion. I think this is important. The second one is that you were using some words called benefit a lot. Younger guys benefit a lot. That initially I thought, okay, fine, we benefit a lot. Then I realized later on you show that these are just dumb activities that are followed up. So just, how do you, it is such an important question that interoperability itself triggers more trading, but if it's actually bad things, so you guys need to take a stand on that, I feel. Maybe other people. Oh, Boshen.
Yeah. Meghana, I think actually, first of all, I agree with Divya's comments on the framing and the mechanism focus. And more important, I think you can push harder on the behavioral bias, right? Because since you focus on retail investors, and we know they are subject to a lot of behavioral biases, such as trading too frequent, which will result in much lower returns in the long run. So I guess you can try to maybe dig out more of their behavioral bias and package this paper in a way more like, okay, democratization is a good thing, but investors should be educated. I remember when I was in Hong Kong, guess what? When you open an investor account, actually you need to do a survey. Actually, not survey, it's almost like a test. Okay, and you have to do that annually, otherwise you cannot trade stocks, which kind of educate investors what they should know before they invest. I don't know whether like in India you have this kind of rules or not in one state or one province and not another province. Probably you can look at that. And I know currently uses urban and the rural area, but maybe this kind of education could be another way for you to deliver policy implications. Yeah.
China does that too. Mainland, I mean. I don't know if it's India to do this kind of thing.
Maybe I can respond to a couple of these comments
respond.
and then take more comments. I just want to say that this is a pretty early draft. Like we've just taken it on the road, so all your suggestions are very well taken, and they're going to be very helpful to us. One quick thing, I mean, on the framing and sort of talking about the intuition and so on. On the on this question about whether it's public versus private banks that Divya raised, I think it's a fair concern, but let me just sort of reiterate, how we thought about this, right? So in the within investor tests, we're comparing the same individual trading through brokerage accounts linked to early adopter banks and other banks. So if it were just about private versus public, then you shouldn't see the same investor trading more in one account versus another. But our results actually show that they do, right? So that's one point. And the second point is that the bank holiday results actually also help in this situation, because if it was bank characteristics that we're driving with, including public versus private, then the relative advantage of these high UPI banks should persist on these holidays. And that's not what we find. We actually find that the gap is actually, narrowing.
So I have a question. So in China, holidays doesn't affect your money movement. What do you mean by holiday in this particular?
Well, so these are bank holidays where the banks are closed, but the stock market is open, right?
Okay, when you say bank are closed, can I move money out?
So you can't do physical trading. So a large part of trading is physical, and there's also this UPI enabled other type of digital trading that goes on, right?
Yes.
So what we're basically saying is that when there is a bank holiday, the physical trading angle is shut, is closed, right? So all you're left with is this digital trading stuff. So if it was about bank characteristics, then you should see that these high UPI exposure PIN codes continue to maintain or have a higher benefit, right, through these, or see more participation from these UPI channels than in the low exposure PIN codes. But that's not what we find. And
Isn't
I think
it
Pulak,
the opposite then?
do you want to say
Sorry.
anything?
So suppose that it has nothing to do with the characteristics. That's what you want to show.
That's right.
I would say that then holiday or not holiday should be the same because we always use the UPI.
Holiday or not holiday, you should see that these high UPI exposure pin codes maintain their advantage.
Yes.
Okay?
Did you
maintain their advantage, or if
that?
anything, are going to see. But that's not what we find. We actually find that the gap between high and low exposure pin codes is narrowing. So this advantage that it's not about the bank, it's really about the UPI. So that's sort of our interpretation of that negative sign on the triple interaction.
Okay, so in the next round you might just make it more clear.
Make that clearer on the thing. Yeah.
You might be right, just wasn't clear.
But I mean, going back to your point, I think, yeah, I use the word benefit a lot, but it's about participation. And I think our last results, which, as Poshwan was pointing out, is the key crux of the paper, right? It's democratization, but this extra risk. And I'm open to suggestions on how we can focus more on these behavioral biases. The issue with the Indian data is there are no detailed sort of PIN code level financial literacy surveys. So we've looked hard, we're not able to find ways of classifying which areas, the investors are more sophisticated. And this urban-rural divide, unfortunately, seems to be the best that we can get at. There are, all the other measures that we're looking at are sort of much more aggregate at the state level. But I completely take your point. I think that is the real contribution of the paper, that you're getting more people to participate, but there are these unintended consequences. And any specific suggestions that you might have on how to dig deeper into these behavioral biases, would be more than happy to take a look at.
Good.
Yeah.
And
your point about the setup is definitely well taken. Yeah, we have a figure in the paper, but we need to elaborate on that. And then
how do you move money around? But can you tell us that before the UPI, how do they move money around?
Actually, maybe what I can do is share my slides again.
Okay.
And
after you sharing, explaining, we will end this
seminar. Maybe not the slides, but let me just share
Right.
So essentially what you see is this is how stock market fund transfer used to happen. This is the traditional process was UPI. Now, actually, even before this, right, before you had these instant RTGS, NEFT transfers, basically what would happen is that every investor needed to have a demat account, like a brokerage trading account, which is independent of the bank account. So you go into the bank, you open up this brokerage trading account, and then there is this, you place a trade with your broker, and then that gets executed in the market. So that is like the really old school traditional type of things. Then you have this, what we call is the traditional process here, which is the brokerage. You log into the bank account, the brokerage is added as a beneficiary, you initiate your NEFT or RTGS transfers, and then there is two-factor authentication. You wait a couple of hours. There are some charges involved. RTGS, I think there is a minimum limit that you need to transfer to enable RTGS. NEFT, I think it's not instantaneous. There is a time lag. So each of these have some frictions associated with them. Okay, so some of them are limited hours or processing time, or there are transfer charges. And then you look at this UPI framework that we have here, wherein you select the UPI in the brokerage, you enter the amount, UPI ID, you approve it in your UPI app on your mobile phone, you enter the PIN, and boom, you're done. Available 24/7, instant transfer, 0 charges. That's the thing that we're trying to.
No wonder they're going to trade more.
Yeah, exactly. So that's much more easier access to funds, right? And that's why you see these small investors, especially in these rural areas, probably we would call as financially not very literate, are the ones that are seeing these long-term negative returns. But showing
Thank
those
you.
behavioral biases and showing that these are the illiterate guys or the dumb investors is the challenge, and that's what we're struggling with. Yeah.
Thank you so much for this wonderful seminar. Yeah. Thank you.
Thank you, Divya.
Thank you, everybody. Thank you,
Thank
Goshen.
you.
Thank you, all
Okay,
the
thank you,
all the
Zigo.
authors.
Thank you,
Bye.
Goshen.